Most people don't lose money because they pick bad investments. They lose money because they don't know whether they're speculating or investing. And that confusion, between speculation versus investing, short-term trading, and long-term positioning, quietly destroys portfolios every single year. Two people can buy the same asset, on the same day, at the same price, and one slowly builds wealth while the other panics, sells at the worst moment, and walks away convinced the market is rigged. The difference isn't intelligence. It isn't access to information. And it definitely isn't luck. The difference is time horizon, investment mindset, and whether you're playing probability versus prediction. Today, we're breaking down the real difference between speculation and long-term investing, and why most investors confuse this, even when they think they don't. Before we go any further, make sure to hit that subscribe button. This channel is about clear thinking, smarter financial decision-making, and long-term wealth building strategies, without hype, noise, or gambling disguised as investing. Alright, let's get into it. Why this confusion is so common. Most people don't wake up and say, "Today, I'm going to gamble with my money." Instead, they say things like, "I'll just see what happens. This looks promising. Everyone's talking about it. I don't want to miss out." Those sentences sound harmless. They sound reasonable. They even sound responsible. But what's missing is intention. Without realizing it, many people drift into speculation in investing, not because speculation is wrong, but because they never clearly defined what game they're playing. Here's the core truth most people miss. Speculation and long-term positioning are not good or bad. They are simply different approaches with different rules, risks, and expectations. Problems begin when you unknowingly mix those rules together. That's when frustration sets in. That's when confidence disappears. And that's when people quit investing altogether. What speculation actually is? No judgment. Let's clean up the word, speculation. Speculation isn't stupidity. It isn't reckless by default. And it isn't automatically gambling. Speculation is short-term decision-making driven by uncertainty, narrative, and prediction. It usually involves a shorter time horizon, a specific outcome that needs to happen, higher sensitivity to market volatility, a sharper risk versus reward profile. In speculation, timing matters more than durability. You're asking questions like, what will the market do next? How will people react to this news? Is sentiment about to change? Speculation shows up most often in short-term trading, speculative assets, hype cycles, and early-stage trends. And here's the part most people underestimate. Speculation requires emotional control, speed, and precision. Most people think they have those traits, until the market moves against them. Why speculation feels exciting, and dangerous. Speculation feels exciting because it offers speed. Fast gains. Fast feedback. Fast emotional payoff. The brain loves speed. But speed comes at a cost. The shorter your time horizon in investing, the louder emotions become. Fear and greed in markets start driving decisions. And discipline quietly erodes under pressure. This is where emotional investing takes over. You stop managing a strategy and start reacting to price. Every chart becomes a verdict. Every dip feels personal. And once price becomes your primary signal, capital preservation stops being a priority, even if you don't realize it. What long-term positioning really means? Long-term positioning is fundamentally different. It's about placing capital where time does the heavy lifting, not emotions, predictions, or perfect timing. Instead of asking, what will happen next week? You ask, where does this fit in a 5, 10, or 20-year picture? Long-term investing is rooted in buy and hold strategy, thoughtful asset allocation, an understanding of market cycles, and the power of compounding returns. You're not trying to predict short-term outcomes. You're positioning yourself for long-term probability. This is where probability versus prediction becomes powerful. You don't need to be right today. You don't even need to be right often. You just need to stay aligned over time. Same asset, completely different outcome. Here's where the difference becomes obvious. Two investors buy the same asset. Same price. Same market. Same day. One is speculating. The other is long-term positioning. When price drops, the speculator feels panic and urgency. The long-term investor pauses and reassesses fundamentals. When price rises, the speculator feels pressure to act. The long-term investor stays patient and grounded. Same asset. Same information. Completely different emotional experience. That difference is investment mindset. Quick pause. If this perspective is helping you think more clearly about investing, make sure you're subscribed. This channel focuses on discipline in investing, long-term thinking, and wealth-building strategies that work in the real world, not just on spreadsheets. Let's keep going. A quick word on crypto. Where confusion explodes, crypto is one of the clearest examples of speculation and long-term positioning getting blurred together. Many people say they're in long-term crypto investing, but emotionally react to every dip, headline, or tweet. That's not positioning. That's crypto speculation with a long-term story attached. A real Bitcoin long-term thesis, for example, requires understanding volatility, accepting multi-year drawdowns, and committing to a clear time horizon before you invest. Without that clarity, investing versus gambling becomes a very thin line, especially in volatile markets. Why people switch strategies mid-game? Here's the silent killer most portfolios never recover from. People start as long-term investors, but behave like speculators when stress appears. Or they enter as speculators, then convince themselves they're long-term when price goes against them. This strategy switching creates confusion, inconsistency, and emotional exhaustion. A real investment strategy doesn't change just because emotions get louder. If your plan only works when markets are calm, it isn't a plan. The one question that fixes almost everything before making any investment, ask this. What needs to be true for this to succeed, and how long am I willing to wait? This question forces clarity. If your answer is vague, emotional, or time compressed, you're speculating. If your answer is structured, patient, and probability-based, you're positioning. This single question improves financial decision-making, portfolio construction, and long-term outcomes more than most people realize. Both have a place. If you're honest, here's the mature truth. There is nothing wrong with speculation. There is nothing wrong with long-term investing. The danger is confusing them, or pretending one is the other. Smart investors separate. Core long-term positions, smaller, intentional speculative plays. They manage risk consciously. They respect capital preservation. They know exactly why each dollar is invested. That's how real wealth building strategies are built. What successful investors actually do. Successful investors don't try to predict every move. They understand market cycles. They respect risk versus reward. They practice patience in investing. They rely on systems instead of emotions. They don't need to be right all the time. They just need to avoid being wrong in emotional, irreversible ways. If this video helped you see investing more clearly, make sure you're subscribed. This channel is about clarity over chaos, systems over hype, and long-term positioning over speculation. And if you want to keep learning how to think about money the way successful investors actually do, watch the next video on screen right now. I'll see you there.